Okay, so now we're getting into Chapter 16, Partnerships, Formation, Operations, Changes in Ownership Interest. And we're going to take this chapter to talk about the legal characteristics of partnerships, some of the ideas behind that. We'll go through the initial investment valuation and record keeping. We'll talk about the difference between for-profit, not for-profit, profit and loss sharing agreements and their computation. We will take the value of a new partner's investment and an existing investment. And here's the one that you're really going to have some interesting homework on is when you value the partner's share or distribute it after a partner discharges their relationship. So let's get. Okay, so the Revised Uniform Partnership Act has been adopted by most of the states, including Oregon and Washington. Now here's a little fun fact. The one state that has not adopted the Uniform Partnership Act is Louisiana, and part of it is their legal system. There's still a lot of holdout from the French and Spanish practices of law, and if you can imagine, we live in a state system, so states have a lot of power to do what they want to do. So anyway, it's the only one that has not done the Uniform Partnership Act, and they have a civil code that they do their legal work from. So just a little interesting stuff. Okay, so the entity theory says that partners can share their ownership of the partnership, but not its individual assets, and they can disassociate without dissolution of the partnership. So there's some exciting stuff, because one of the things that's nice about partnerships is people can enter and exit the partnership a lot easier than they can a corporation or a sole proprietorship, particularly a corporation, because as you remember, we've spent the first third of the class talking about subsidiaries and business consolidations, A plus B equals A plus B equals C, and that sort of thing. So disassociation, if a partner needs to retire, they can go ahead and disassociate, and the partnership, the company, will keep moving on. Of course, in a corporation, you have that double taxation aspect of it too. So I guess you could sell your stock at a corporation, but the actual company, if it wanted to shut down, you would have a lot of work to get that done. Also, partners have mutual agency. So the idea that a partner can go out and represent the partnership and make decisions based on the whole entire entity. So for example, if they want to buy another building for their entity, if it's a law firm or a doctor's office, one person can go out and do that and act and sign papers on behalf of the entire partnership. So it doesn't take every single person in the partnership to do that. It's kind of a cool thing. And then the other thing that's kind of rough is the liability. So partners have unlimited liability. You can get a limited partnership together. I don't know why they don't teach that more, but the basic idea is that they have unlimited liability unless they choose to do that route. Okay, so the articles of partnership are as follows. You have to draw these up to specify what you're selling, the partner's rights and responsibility, how much you're initially investing, and this is important, the value assigned to non-cash investments. So for example, if a partner sells an office or brings somebody else in and they've already bought all the computers and desks and everything, and they bring a new partner in a form of partnership, then the person that brought all the non-cash investments, which would be, the furniture and fixtures and computers, would have to make sure that that they agreed upon an assigned value. Any additional investment conditions, the provisions to withdraw assets out of the partnership, sharing profit and loss, and procedures for dissolution. Okay, so financial reporting. Remember, the goal of financial reporting is to provide information to outside users. So it should provide for the needs of the partners, creditors, and the IRS. Now, here's the big bonus for becoming a partnership. Guess what? You don't pay federal income tax. You do pay taxes on your personal income, and basically it just flows through to your personal taxes. But unlike corporations who have that double taxation, partnerships do not pay federal income tax. All right, so let's look at some calculations, some information regarding the initial investment to start a partnership. All right, so the first thing we're going to look at is Ash and Beck, who are investing cash. All right, and this is just a simple journal entry. First thing we're going to do is debit cash and credit capital for each individual person, and then valuing these individual assets right here and crediting Beck capital for any of the items, making sure those are put into Beck's capital account for the non-cash, as we had discussed earlier. All right, so let's say you have a bonus or a goodwill on your initial investment. So the partners' investments may not represent their ownership percentage. Okay, so you don't necessarily, like we were talking about that partner that brought in the furniture and fixtures, even though they gave a whole office full of furniture, that may not represent what their percentage ownership is going to be in the building. For example, a great example I've seen this a ton of times, CPA comes in, has a lot of furniture and fixtures. The other CPA has a lot of clients. They decide they want to do an office on one side of town. So the first CPA shuts down their office and all of their, sells off all their stuff and merges with the second one, and the second one brings all the furniture and fixtures to the office, but they would share equally. So one may appear to be investing more than the other, but they also may have connections, talent, intellectual know-how, all sorts of stuff. So the partners can choose the method to record their capital when there's two ways they can do it. They can do a bonus method, which shows their adjustments in the capital accounts, or they can do the goodwill method and just record. Okay, so let's look at this initial investment with bonus. So in this particular case, the total fair value is split between partner and capital accounts as desired. So we have Cole and Crow. Now, I usually like it when they do two different first names. This is one of those that, like, you could easily look at the partner wrong. So I'm going to come over here and underline them just so that you could kind of see who is who. This one I'll put in red. Eraser. This one I'll put in red. And then the other one I'll put in blue so you can see who's who. I don't know. Normally they break up the names to make it a little easier. Maybe they're trying to challenge you. So we've got Cole and Crow, two C names. Okay, so Cole contributes $50,000 in assets and Crow contributes $42,000. They agree equal shares. All right, so to get the shares, you add these together, 50 plus 42, right here, plus 42. And that's your 92 right here. Divide that by 2, and they have 46 each. Okay, so if you look at it right here, in the assets right here, Cole contributed 50, right? So this is Cole's, oops, change my color here. Try and keep those reds and blues separate. Cole contributed 50, so we're going to put it on for what he contributed, or she contributed right here. The he or she contributed 50 of the assets, right? Crow only contributed 42. So put that in here, right here. So that's our starting point for the journal entry. And then we basically list out the assets as they are, not knowing who contributed what. Okay, so let's take a look at this initial investment with the bonus. And what I did here is I actually brought in from the last page so you can see kind of how it works. So the first thing we're going to do is get everybody to 46,000. Remember from the previous page, the total assets was 92. Divide by 2, and they get 46 each, right? So we need to make sure they have 46 each. So to do that, we're going to have to subtract off 4,000 from Crow, or Cole, sorry, Cole. See these C names. We're going to have to subtract off 4,000 from Cole, so we'll debit for 4,000 and give that 4,000 to Crow right here. And that'll add, we're going to basically add 4,000 here. So this is a plus 4, and this is a minus 4. And then both ownerships will be equal to 42,000. Or I'm sorry, 46,000. 46. Okay, so one of the things I would suggest you do is go back to your book while you're walking along with this with me, just so we don't get lost of who invested what. Page 508, as you're listening to this lecture, take the screen and scroll through your book. I think you're just going to find this is a wonderful way to do it, okay? So the first thing is who invested what. So I'm just going to put R or L down here at the bottom, just so we can keep up with who's doing what. So for the L investment or Cole investment, Cole put in the following: land, building. And for the R part, which is Crow, Crow put in the cash, trying to make an R, and the inventory. So now you know who did what. All right, so cash and inventory, here's my blue spot, and here's my land and building, here's my red spot, just so you can kind of see who's doing what, okay? So now let's go ahead and the partner that contributes the greater fair value sets the implied value of the partnership. So the person that sets the implied value is going to be Cole. I'll put this in red so you can see it's going to be Cole, because Cole put in more. You could quickly add, say, 50 versus 42, and we did this earlier here. Again, 50 versus 2. So first thing you need to find out is who put in the most. That's the implied value of the partnership, okay? So the goodwill is recorded for the partner who invested the lesser amount. So this here, we take 35 plus 7, 42, divided by 50%. That'll gross it up to 84. So we have a goodwill between the two of these. All right, so here's our journal entry. All right, so here the first initial entry is going to be the goodwill for Crow for $8,000. All right, now each partner has his or own accounts in the partnership. For capital, which is the balance of their equity; drawings, which is similar to their salary. Their partner drawings are usually their salary; and withdrawals, which are large, unusual amounts. For example, if you have to take out a bunch of money to buy some sort of piece of equipment. Additional investments increase the capital. Drawings and withdrawals reduce the capital. All right, and then they use the income summary just like others do, revenue and expense summary, and then they close it to capital. Remember that in a corporation you close it to retained earnings. Okay, so let's look at the end of the month for the partner closing entries. So the first thing you're going to do is do your income statement, revenue and expense summary. You guys remember that from beginning accounting back in the good old days, right? Rat and Yan are going to close out their net incomes to a revenue and expense summary, and then they're going to credit their capital for this revenue and expense amount. Then here's where they take out their paycheck. Rat takes out their paycheck for $6,000, reduces their capital. Yan takes out $9,000, reduces their capital. Income is shared between the partners. If there's a loss, one of the partners has a loss, then the entry is reversed, and some partners can have overall losses while others have overall profits. All right, so let's look at the statement of partnership capital. Here you can see that Rat is 60% owner, Yan 40%, right? Doesn't always have to be 50-50. You can see where Rat added an additional investment, Yan deducted a withdrawal, and these are the drawings. These are the 2 paychecks that we just saw. This, once you add this, subtract this is your net contributed capital, and then you add back the net income for the year to get the capital balance. All right, so let's look at the profit and loss agreements for partnerships. Partnership articles should clearly state the means of distributing profits and distributing losses. If you don't clearly state that, then you're going to have a lot of arguments amongst the partnerships. And some of these things are commonly considered at the time, in addition to time and investment given. Bonus allowance, salary allowance, interest allowance on capital invested, and a share of the remaining amounts. All right, so here is how you figure bonus and salary allowances. Bonus allowances are often based on partnership profits and may be before or after salary allowances and bonus. So if the bonus is both, all right, the bonus is equal to the percent times the net income minus the salary allowance minus the bonus. All right, and salary allowances are generally predetermined amounts provided by the partner who manages the partnership, and they are not expenses in the determination of net income. So here's a little tidbit. We're so used to doing wages and salaries expense. When the partners get paid, it doesn't come off the revenue and expense account. Not expense. Very interesting. Look at interest allowances and capital. Interest allowances are generally based on the measure of the partner's capital. So we want to get kind of a clear idea of how much they've got, how much skin they've got in the game throughout the year. So we take the beginning of the year capital balance, the average capital balance for the year. So we take like a weighted average as their capital balance fluctuates. And then the ending capital balance, which is the beginning balance plus withdrawals, minus withdrawals plus investments. Now, periodic drawings are ignored, they're salaries, but withdrawals are considered. Okay, so the way we allocate income, the partner's allowances for bonus, salary, and interest are allocated to them, whether or not sufficient profits exist. So they don't have to do a good job to get their paychecks. Very interesting. Well, I mean, I'm sure you can write a partnership however you like, but that's usually how that rolls. Remaining profits are split according to agreed upon proportions, and these are general procedures. Partnership articles have specific requirements. So let's do Leo and Drake. They're going to share the profits and losses. Leo and Drake have $60 and $30 salary allowances respectively. Leo has a bonus of 50% of profits in excess of $500. Each has interest allowances of 10% beginning capital. So at the beginning of the year, Leo Capital 1-1 had $400. Drake Capital on 1-1 had $350. The remaining profits and losses are shared. Leo 60%, Drake 40%, and the partnership profits are $660 for the year. Okay, so let's take a look at Leo and Drake. First thing we have is our net income $660. All right, and that we're going to go ahead and we're going to run a separate column for the running net income. Then we're going to do the salary allowance for both of them added together. So here's where Leo and Drake, here's that respectively. Remember, it's first, second, right? So Leo has 60, Drake has 30, and that comes down here. All right, the bonus. So there's a bonus allowance. How do we figure that bonus? The first thing we do is we take 50% of the net income, which is right here. Oh, here we go, right here, sorry. Yeah, partnership profits. Then we're going to subtract out the bonus amount. So what happened is Drake, if he had a bonus of 50% of profits in excess of 500. So anything over 500, Drake gets half the profits. So we have to subtract out the 500. All right. Once we do that, that comes up 50% times 660 minus 500 equals 80. All right. So this is the bonus allowance. And we're going to take this off as a subtraction here, but it's going to be an addition right here to Drake. The next thing is the interest allowance. The interest allowance, all right, we have two things going on. Interest allowance of 10% of the beginning capital, 400 was Leo capital, 350 was Drake capital. So we multiply these 400 times 10% right here, and 10% times 350 for Leo and Drake. All right. So now remember, again, see here, these are additions to Leo and Drake, but they're a subtraction for the whole. And this is where we get that subtotal. At the very end, we split based on what's left. So Leo gets, let's see here. Leo gets 60%, Drake gets 40%, 166, 249. Again, this comes out as subtraction. At the end of your allocation, net income running on the left should be 0. These two have 349 and 311 as their allocated net income. Okay, so let's run it again, and this time we're going to assume that the income is only 120. All right, so here's our income. So it's a little less. We're probably going to be a little bit in the hole this time. They didn't have as good of a year. So here's our net income. Again, we run a separate column as our total on the left. All right, so again, the salaries are unaffected. Leo and Drake get 60 and 30 as normal, and this comes out of the total as a subtraction. There's no bonus because it was a bad year, so we don't. This just didn't happen. All right, so that's just you put it as a 0. If you're doing it on your homework, just go ahead and leave the bonus allowance in. It's a lot better than trying to like rewrite it 10 different ways and forget. Just set up this chart if I haven't already set it up for you, and then if you're doing it like as a remembering thing, put the bonus allowance in. That way you'll always remember to do the bonus. You don't want to forget to do it. All right, interest allowance is 10% of the beginning capital. Again, despite the fact that they had a bad year, they still get the interest allowance, and it's taken off as a negative or a reduction in the net income. Looks like we're already in the hole for 45. So what we have to do is split that deficit between the two of them based on their ownership percentage. So 60% is negative 27, 40% is negative 18 between Leo and Drake. All right, so let's look at adding a new partner. Somebody new is joining the fray. All right, so if you add a new partner, there's the methods of entry into an existing partnership are as follows. A new partner can purchase interest from an existing partner doing the goodwill method or the bonus method, which we explored earlier in this lecture, or the new partner can invest directly into the partnership using the goodwill or the bonus method. So they can either invest more stuff or buy. Okay, so let's look at Alf and Bal. Okay, Alf has a capital balance of $50,000 each, and each has 50% of interest in the firm. Isn't that just friendly? Like, that's super easy. I hope you just notice the niceness here of this book. All right. Cobb buys half of Al's interest for $25. So what's happening is Alpha's going to step out a little bit and reduce their interest in the partnership. And there's going to be a new person, Cobb. So we have A, B, and C. All right. So what's going to happen, the first thing we do is do the journal entry to reduce Alf's capital. That's going to be a debit. Remember, capital is credit account. And we're going to credit Cobb capital for 25. So that's going to reduce down Alf. Now, Alf is only 25 in it, and Cobb has a new 25%. So what you have to do when you're figuring this sort of thing out, to figure out the ownership percentage, is you simply want to do like a before and after comparison. And right here you can see the percent of capital, 50-50. Now we have 25 to Alf, 50 still to Bal. Bal was not affected, and 25 to Cobb. So you have 25, 50, 25 ownership. Okay, so let's look at Alf and Bal. Alf and Bal have capital of 50 and 40, each with a 50% interest, so new problem here. And they're going to pay Cobb $50 directly to the partners. Cobb's going to get 50% of the interest. Alf and Bal are going to keep 25, and the assets are at fair value. So let's just scope this. Let's map this out. What's going on? Okay. So Alf and Bal, A and B. Okay. And I like to write this out. I think it makes it so much more understandable. Alpha is going to have a capital of 50. Okay. And then they're going to go, and they currently have 50% ownership, right? But that's going to strike out. That's going to go out and become 25. All right, and let's look at Bal. Same situation. Bal has 40 capital. All right, and 50 ownership. And that's going to strike out. That's going to go away and become 25 too. And then what's going to happen is we've got this new partner called Cobb. So I'll just put them in the green. Cobb is going to get 50% of the partnership. So the partnership is going to end up being 25, 25, 50. Alf, Bal, and Cobb. Okay, so I like to sketch it out. I think it helps you understand like what's going on. We're trying to figure out where to get the numbers. The first thing we're going to do is do the implied value of the firm. So the implied value of the firm is always the partner that has the most capital. So who's got the most capital? That is going to be who? Alf, right here. Alf has 50, remember from earlier? So we take Alf's capital amount divided by 50%. This grosses up to 100. Then we're going to subtract out the old capital. The old capital is right here, 50 and 40 added together. Okay, and that becomes 90. The goodwill is 10. So now that we have the goodwill, that's going to increase Alf and Bal's capital because they have a 50-50 split. So we haven't done the transaction yet. So this 50-50 between them is going to go into their goodwill account. This $10 is going to go into their goodwill account for 5 each. Okay, so let's look at buying from the partner and doing the reevaluation. So we do the reevaluation before we actually do Cobb hopping into the picture. So here's the before where we had 50. We add the $5 goodwill to each. The revaluation becomes 55 and 45 between the two of them. And that brings it up to 100%, $100, right, with the goodwill added in. Now you can do the transfer right here. Now you can do the transfer to Cobb and take out 25 each from them and give Cobb 50. And then here's the final valuation. Subtracting this one, subtracting Alf, subtracting Bal 25, leaves you 30, 20, 50 for a total of 100%. I'm not going to talk about if they decided to realign the capital. I'm just going to keep that part quiet. Okay, so let's say they decided not to revalue the assets or record goodwill. If that's the case, then they use the bonus method. Okay, so again, here's the before and after. We're going to take the transfer off. Okay, Cobb's capital. We're going to do that first. We're going to take the 50% of 90, which is the total amount right here, added together, and that gives Cobb 45. All right, so we do that part first. Then what you do is split the 45 in half to give a final valuation of to each one. 27.5 to Alf, 17.5 to Val, and then Cobb gets 45. So first thing we do, and this is weird because we've been using the largest amount to do the valuation. It's different with the bonus method. So we just take the total, half it, and then distribute it amongst Alf and Val. Okay, so here's the entries for Cobb's admission under the goodwill and the bonus method. You can see the differences here. We didn't align the capital accounts. In the goodwill method, we did align the capital accounts. And you can see here the differences in the capital amounts, kind of still going in the same direction for the breakdown. The big difference here is this big amount allocated to. Okay, so we have a new partner coming in, and we're going to allocate goodwill to the old partner. So the first thing is Dre and Boy have capital balance of 40 and share equally in the firm. So the firm is worth $80 basically. Old investment added together. But before I hop on that, let's talk about the implied value of the firm. So Cry is going to be admitted for $50 cash, and he or she is going to be a third owner partnership. So to get the implied value, I know we've been doing 50% this whole time, and you're probably thrown now, like, why aren't we dividing it by 0.5? But that's not right, okay? It's got to be their percentage ownership of this firm. So we'll divide this by 1/3, and then this is our implied value. And since the other weird thing is, Cry happens to be the person that has the most capital assets at this point as they do their new admission. So that's how we do it. So that's why we pull the $50 in for the implied value of the firm. All right, so now that we've got our implied value, which is what based on Cry's investment, which is a little different because last time it was the old owner's investment. Now we're going to look at, we're going to take off, we're going to add the old capital, and then we're going to add together Cry's investment of 50 to get 130, and subtract that out of the implied value to get 20 goodwill. All right, so you can see here, this is a nice breakdown. Before we reevaluated, we started with Dre and Boy, they had 40. Then the 20 goodwill is broken between the two of them at the reevaluation. Hopefully you all are really good with those. So the reevaluation comes up to 100. All right, so we add that back in. This is plus, right? Plus. All right, and then here is finally Cry's investment, and this is how we get to the finish line. Okay, so now we have a new situation where we're getting goodwill to a new partner. Dre and Boy have capital balances of 40 and share equally in the firm. Cry will be admitted at an investment of $50 cash. Cry will be given a 40% share. Dre and Boy will have 30%, and their net assets are at fair value. Goodwill will be recorded. Okay, so here's something that I think you would like, just so that we can like not get thrown off. In this particular case, to get the implied value, they added the two capital balances together and divided by each of their shares. What I've been teaching you to do all along gets you in the same direction. You can take the person with the highest capital balance, in this case it's both, so you could use either one, take 40 and divided it by 0.3, and lo and behold, it'll get you the same amount. Now if you're used to following a procedure, just use my method. It gets you the same direction as the book, and it's actually a little easier to understand. So if you have two, they have the same capital balance, just take one and divide it by 0.3. Now we'll add the old capital together as we have in the past and the additional investment, subtract those off, and we have a different goodwill amount, 3.3. Now, is this going to the old partners? No, it's going to go to the new partners. So here we go. First, before Dre and Boy each had 40 each. All right. Now, at revaluation, in the past, we were giving it to the old partners. In this case, Cry is starting out in the positive with the 3.3. They have no revaluation because it's going to the new partner. Then we add Cry's investment, and we have 53.3. Okay, so we're going to talk about the death and retirement of a partner. The partner has decided that they are no longer going to be part of the business, or the partner is lost through unfortunate means. So we have, under the Uniform Partnership Act, the firm value is figured at two things: the greater of liquidation or sales value as a going concern without the disassociated partner. So one of those, whichever is bigger. The payment to the existing partner may be equal to the retiring capital, more than the retiring, so there's a goodwill bonus, or less. And then what you would do is write down anything overvalued or give a bonus to the existing partners. Okay, so let's look at Ann, Mike, and Juice. Ann, Mike, and Juice are partners with capital balances and profit sharing percentages as follows. All right, and the percentage of capital is Ann has 70,000. Mike has 50,000, and Juice has 80,000. Okay, so you can see the breakdown of capital. The profit and loss percentage is 40, 20, and 40. Okay, and then Juice decides to retire, and his partnership interest is paid out by the partnership. So let's take a look at what that looks like. So the first thing we do is the payment is equal to the partnership capital of $80. So Juice is just given 80 in cash. Then Ann, Mike, and Juice partnership would be dissolved, but Ann and Mike get to continue, and they'll just reestablish a new partnership agreement if the partnership's retirement was not addressed in their original agreement, and most original agreements probably would address that. Okay, if Juice paid $92,000 in the final settlement of his partnership interest, the excess would be treated as a bonus to Juice or goodwill in the amount of the excess, or you would revaluation of the partnership capital based on the fair value implied by the excess. So this is what it would look like. So in this case, remember, Juice, or the capital was 92, right, instead of the 80. All right, Juice's capital is only, Juice's capital is only worth 80, right? So the bonus would be a debit to Ann and Mike based on their 40-20, their sharing ratios in the 12,000 bonus. So they actually reduce their capital by the bonus. All right. The excess payment is a debit to goodwill. It's a debit, remember, and it's also, again, we're taking off Juice's capital and then cash. So it'll be a debit to goodwill. Now, Ann and Mike's capital accounts are not revalued if the goodwill is recorded. Okay, so now these slides we're going to revalue the partnership capital against the goodwill. So we're going to credit all three of the capitals right here and debit the goodwill. And then the excess payment is going to be used. Now we have a new implied fair value. So we're going to take the excess divided by the 40% share, and that's going to be equal to the implied undervaluation of 30,000 for Juice capital. All right, let's look at limited partnerships. Limited partnerships have one or more general partners with unlimited liability for partnership debt. So a limited partnership, the general partners have kind of the lion's share of the responsibility, and then there might be other partners that don't have unlimited liability for the debt. There may be a number of limited partners. They're excluded from participating in management, so they're not going to have the unlimited liability like a general partner. And then they have limited liability for debt, and then of course the partnership agreement must be in writing, signed, filed. All right, so final thoughts. Work hard on your homework this week. I hope this was helpful in you solving the problems. And hang in there. We're getting really close to the finish line. Thank you very much.